I'm Jan Kram, speaking now on the top level probably of your screens, and also on behalf of Elena and Irene, who helps us today to organize this session. I want to welcome you very much, very strongly for our first workshop that we are organizing in this RPN on European Financial Architecture. It's a premiere, so to speak, in this, and we try out also how we interact, and this is, so to speak, our first attempt to set up a platform for debate. And we are happy that we have that we are endowed with diverse experiences and expertise, not only through the members of the RPN, but also through our guests that we will introduce in a short while. But I think what unites us is this common interest in the functioning of the financial system, and of course also its improvements. And we bring in these different expertises, which hopefully can communicate well with each other. So let me say a few words as introduction to the topic. The topic climate change is now everywhere, right? So it's nothing original to put this in the title. Wherever you look in newspapers or policy agendas, this is one of the top topics that are being discussed, and also the risks that emerge from the transition process to a hopefully more sustainable economic model. Both of these topics have gained enormous attention in recent years. Whether this is at the firm level, I think of the agendas of annual general meetings in many countries, or the national and supranational policy level, think of Paris Agreement and many other policy meetings since then. It seems therefore only a legitimate question to ask what we as finance experts, mostly in academia, but also in industry and policy, can contribute to a better transition path for our societies at large. At least that's in a way the question behind and the interest behind our initiatives. The workshop today will address the issue of climate change from the viewpoint of financial stability. And of course, we are very happy, as I said already, to welcome distinguished experts from 3 different fields: reinsurance, corporate banking, and central banking, that will prepare for us the ground for a competent discussion thereafter. I have asked, and we have asked the speakers to be succinct and short. So we said the absolute maximum is 10 minutes for their starting impulses, so that we have time for a lot of discussion and questions. I think this workshop will be deemed a success if in hindsight it has contributed to some relevant note or statement or maybe even academic work that can emerge from it. Thank you so much for the introduction. So I want to turn to our program, which basically starts with one section which we call State of Play. These are the introductions, and Elena, Irene, and I will basically introduce each one of the speakers. So from the 3 statements, I will introduce the first one, which is Jérôme Jean Hegel, together with André Garbas from Swiss Re. And I asked them earlier on to talk about measurement and pricing of climate risks, but so more generally also their approach as a reinsurance firm in basically coming to grips, coming to metrics with the issue of climate risk. Let me say a few words on both that will speak and present together. Jérôme Hegel is the Group Chief Economist of Swiss Re, where he has been working for many years, I think 14 years now, and eventually in the role of the Group Chief Economist, but he has spent other years in other functions. He has been also a senior economist with the Swiss National Bank and advisor to the IMF. His academic record is basically studies at the LSE. He was spent some time at Harvard University afterwards and concluded his PhD at University of Basel in the year 2000. And Andre Galvas is working with Jérôme. She's an economist, a senior economist at Swiss Re's, I think, research and analytics group. And so I'm happy that you are here. I would like to give the floor to you now.
Thanks a lot, Jan. Thanks a lot for the introduction, and it's great, really great to be with you. I'm super happy to see also in the background on your wall, Jan, the focus that you have in terms of the financial architecture. Exactly, I think the topic that we need, and we need to have financial architecture which makes sense to get the climate risks. In order, we'll always have climate change, but without a change in the financial market architecture, we will not be able, in my view, to get to net zero environment in 2050. We have 10 minutes. We present with Andre Garbo, with Andre, as I just mentioned, and obviously climate change is a very long process. And if you look at this slide, you all know these stripes. They present 1 year of temperature increase since 1850. And if you look at big picture, what's telling the last 15 years, 20 years, these were the really hot years, and you have many tipping points, and that's obviously what we need to avoid in the future. If you look at slide 2, in terms of the really 3 key figures to remember, and you mentioned in your introductory comments, Jan, Swiss Re, yes, we are in the reinsurance business, and yes, we are Swiss, but we are truly global, and Swiss Re is the largest provider of catastrophe reinsurance in the world. We have a very big cat perils team, and we have also a sizable team of economists, and climate change economics is one of our signature topics beside the Sigma research. 3 key figures to remember from our analysis that the Sigma team and economic research team have been doing over the last several years. Some of it now for a very long time, but some of it more recently. Number 1, 75%, 3/4 of the natural catastrophes globally are not insured, meaning we don't have the protection when you have an increase in the severity and frequency of natural catastrophes or man-made events. So we are very much exposed to the effects of climate change. That's number 1. Number 2, and we all know from the studies out there, there's a lot of new investment needed that needs to be forthcoming. There has been a talk of about 100 trillion. It looks like that the figure will be and is a multiple of $100 trillion of new investments needed to decarbonize our economies to get to net zero in 2050. And we will also have from our team here in Sigma Research a new report coming out to pinpoint more exactly how much more than 100 trillion. But it's in any case a huge amount of new investments needed. And number 3, key figures, and Andre will allude to that in a second. Another key figure is a -10. -10, it stands for the 10% impact on global GDP that we have in a baseline scenario that we are in today, which is not meeting the Paris Agreement of an average temperature increase of around 2.4 degrees. -10%, that's very seasonable, but that's not even an adverse scenario or adverse worst case like scenarios. If you look at our research out there with the economics of climate change, which we published last year in our scenario framework, in adverse scenario, the GDP loss by 2050 would be closer to -18%. And that's for global GDP. There is also going to be a lot of variation across regions and countries, obviously. This is a kind of introductory comments now, reinsurance industry. What do we do in this topic? Why do we care so much about this topic? Well, we care so much about this topic because obviously there's no planet B, but also, and I don't think I'm exaggerating here, but I don't think there's any other sector in the private sector side, which is so essential and part of the solution to an existential threat, which is climate change. And we do view climate change as being the number one long-term economic risks. So what do we do in terms of climate change? Obviously, the core of our business is underwriting, so the risk transfer solutions. We are insuring against the negative effects of climate change. We cannot prevent it, that's clear. But what we do, sharing the risk knowledge, can also lead to better policy decisions, climate risk mitigation. But also, and let's not forget, the insurance and the reinsurance industry, they are a key long-term investors. If you think about the assets under management, insurance and reinsurance industry has about 1/3 of long-term investment funds being managed by the insurance industry, amounting to roughly $30 trillion. So we invest in the real economy, we insure the real economy, and obviously there's probably no one else in the private sector with that set of exposure and that set of experience. So I think we're really, really central in terms of the transition, and also making sure that we have a smoother transition to a net zero economy, because today we don't. If you go to the next slide, and I mentioned before the 75%, 75% is the exposure of natural catastrophes to which we are not protected. And that figure is over time pretty stable. Now you see with the graphs on the right-hand side, and this is just for illustration, there's also large variation across regions. And on the left-hand side, and we put that out with our CEPR report in 2020, with our NatCat CEPR report in 2020. Yes, climate change is definitely a driver of the increase of severity and frequency of natural catastrophes, but so is urbanization and the increase of economic development. So please also have a look on the graph on the left-hand side, because you see, if you start normalizing, if past losses or events, like the events in the 80s or 90s would have happened with today's economic exposure, you would have had a different set of natural catastrophes in terms of cost impact. I think this is also always super important to keep in mind. Obviously, human activity has a large play to it, and it's also scientifically proven, but so does also economic development. It plays a very big part in terms of also explaining the rise of the cost of the insured events. That's always important to keep that normalization into mind when you take a longer term perspective, which we do take. Now, with this, happy to hand over to Andre. Thank you.
I hope you can all hear me. So thanks a lot, Jerome, for giving the big picture. And in the interest of time, I will just try to keep my intervention very short. And specifically, I want to speak a little bit more about the details around measuring and pricing some of the physical climate risks that Jerome also basically covered now, and also the factors influencing this. So I think from a financial stability point of view, it's important to think about basically two different angles. On the one hand, as Jerome mentioned, you have protection gaps. So those are things that could have been insured, but were not insured. But then it's also important to think about the issue of insurability. So what can't be insured, or what influences what can and cannot be insured. So then the natural question, of course, is how can we close protection gaps, and what influences insurability? And I think the big picture, of course, is it's not black and white. There are many different factors influencing this. But also importantly, it's a dynamic and endogenous concept. So we see insurability, for example, changing as climate risks change. So to give you a very concrete example, we've done some recent work specifically around floods. And in the US, floods used to be completely uninsurable. This is because they occurred in specific geographical areas. Only people who lived in those areas wanted flood insurance. And so due to adverse selection, there was no scope to diversify. And over time, it has actually become insurable for several reasons. So on the one hand, due to increasing severity and geographical scope of floods, now there is some scope for diversification. So the hazard has changed, and so the diversification risk transfer possibilities have changed. Also on the supply side, modeling, of course, has improved, and the private sector interest and momentum have ramped up. And then there are also some nuances in terms of, for example, differentiating pricing, where the private sector, of course, insures, and then the public sector basically puts some cap to ensure insurability and basically subsidizes some of this insurance. But so a little bit more broadly, just to say that we at Swiss Re continue to regard weather-related risks as insurable. Not only insurable, we actually expect this business to grow in coming years. And this is in part due to the short-term nature of these kinds of insurance, so basically on an annual basis. But then, as I also mentioned, advanced risk modeling tools, better data, also innovative risk transfer solutions, and then importantly, diversification across regions, geographic areas, and different risks and lines of business have also allowed this. But then it's also important to consider, what needs to happen going forward. And that's all around increasing confidence through additional research, improving data, also ensuring that we don't have a fragmented data approach, and fostering stabilization. So I know we're almost out of time, so I'll keep it very short here. That was a little bit around insurability. And of course, there are also things that you can do on the closing insurance protection gaps, which we can discuss more in the discussion afterwards. But that's basically the day-to-day bread and butter of underwriting in the insurance or reinsurance industry. But then we also need to, of course, keep a bit of a longer term view in terms of pricing, for example, the externality in terms of economic costs from climate change. And here specifically, I would mention, Jerome already alluded to it, the economics of climate change research that we did. I won't go into the details here. Again, happy to discuss in detail or share the publication with anyone who's interested, but to say basically that we take a very comprehensive modeling approach and account for several shortcomings in the previous literature, and ultimately obtain estimates of the GDP impact of different temperature paths. And this is by 2050, which is also notable because it's really not that far away. Often studies have a longer term horizon. And here you can see the 10% that Jerome referred to is basically, if you compare the 4.2% loss you would see under the Paris Agreement target for the world versus the likely path that we're on, something between 2 and 2.6 degrees warming by mid-century, you could see up to 10% percentage points higher GDP impact. And just as a final comment, what's also important to take away from this table is basically you can see there are no winners. Of course, there are discrepancies across regions, but ultimately climate change in a sense is not a risk, it's a fact, it's a trend. And in the long run, the insurance industry, the reinsurance industry cannot insure a fact. And so the impact will be borne by businesses, by households, by the real economy, which then of course makes the transition that much more important, ramping up investment that much more important, that Jerome mentioned. And we'll not speak about the transition. Again, we can, I think the other speakers will touch more on the transition and we can discuss at the end. But with that, I'll just give over to Jerome if we can have another brief second just for Jerome to say a word about the way forward.
On the way forward, looking very much forward to the discussion. But if you look at the next slide, and it's also now research that we are publishing and we are working on, we need BW3, which is to say we need a new financial market architecture. Bretton Woods institutions, super important. This institution I worked for, Andre worked for, many of us in this call worked for, and we care about, because they care about the public good. Public good is making sure the climate change effects are in check, but public good is also making sure that the investment barriers for the new investment, and it's going to be a multiple of the $100 trillion which are needed, that these investment barriers are not only lowered, but also that we give a clearer price to the risk, which is climate change. If I just look at it, if I look at the carbon tax today, studies out there show that the carbon tax, effective carbon tax today is about $3, and only about 2% of economic activities has a tax with it. if you look at the research out there from the IMF, the carbon tax should be at least $75 per ton. And that's a big difference. And I think this is really telling you, if you have such a big difference, it probably also means there's a lot of financial market stability risk within, because you need to get from 3 to 75, and you need to get to do that pretty quickly, because each year you don't, you are late in terms of financing the net zero economy, and you are also carrying financial stability risk in that transition phase. So this is from our side, Jan. Looking at the time, I think was actually 10 minutes, so at least we put the box there. Thank you. I'm giving it over to you.
Yes, so thank you, Jerome and André. I will resist my temptation to ask a question immediately and relegate this to a few minutes later and hand over to Elena for introducing Liliana.
Thank you, Jan, and thank you already to the previous speaker, and good afternoon to everybody also from my side. I move immediately to our second speaker, who is Liliana Kortan, and I hope to pronounce the name correctly. Liliana is the Chief Risk Officer of the ING, and she has been in this position since January 2021. Before that, she had a long career in UniCredit. In the last position, she was Chief Risk Officer of EFA Vereinsbank, the German subsidiary of UniCredit. But before that, she also had various other positions, for example, as a head of group credit transactions, or global head of financial institution, bank and sovereign, and also more areas related to marketing of corporate investment. So we are very pleased to have you here. Thanks for accepting our invitation. What we asked you when we discussed the preparation of the meeting was to focus particularly where Jerome and Andrew left, so more on the transition side. How do you see steering your portfolio in order to fulfill the net zero objective? But in general, how are you dealing with the transition risk of your client and your portfolio, both from a managing and also from an underwriting perspective? But I leave it to you. And thanks again for being here.
Thank you very much, Helena, for your kind introduction. And good afternoon to everyone from Amsterdam. I'm very happy to be here today with you. And I understood my role is to give some food for thoughts and some perspectives of the primarily banking within the financial industries around the climate risks and climate resilience, and what is actually the role, in our view, of the banks in that world, and how particularly ING is addressing this role in the world. So maybe let me start with setting the scene, and I would like in the end to form a few of the conclusions that I would then leave open for discussion and questions also in the second part of the presentation. So I don't think I need to go into reminding us what has happened recently with respect to extreme heat waves and droughts in Europe, also Australia, last year floods. So the Mother Earth is reminding us every time possible that there is less and less time, and the time is ticking to the moment where actually we are coming closer to a hothouse world, which we definitely want to avoid. However, we have also seen beginning of this year how certain geopolitical events can short-term eventually derail or present, I would say, a danger of derailing of the global alignment of what is the priority of the civilization. And I do believe climate change and climate transitioning is one of the activities that we will be successful only if we as a humankind and global civilization address it. Why? Because it does not recognize the borders, it does not stop at the end of the continent. So only if we act together and aligned, there will be some positive outcome coming out of it. So also ECB has made it its priority for the financial system to focus on it, and we are more than actually welcoming all of these efforts and are actually very actively participating in all of these. And we've seen the last results of the ECB, for example, stress test, which is incredible if you look at it from the income perspective, because the conclusion was that almost 2/3 of the non-financial corporate sector's income of the banks is coming from the greenhouse gas intense industries. What does it mean? That it presents as well a danger for a banking system in terms of loss of the income. However, what is important also to be said is that we see this as opportunity primarily. Clearly there is, and we've seen in the recent announcements of European Commission, there is a need of huge investments and there is a need of huge funding for transitioning economy. And banks here, and ING particularly, find this as a great opportunity to contribute with respect to our own operations, but also by steering our lending portfolio, advising and financing our clients toward this transitioning. So as banking financial institutions, we do look at the climate risk and climate transitioning from two perspectives, actually from three. First one is clearly from our own operations. Are we carbon neutral, and what we can do to be carbon neutral? Secondly, we have to look at the climate risks at our balance sheet. So what does it mean for all of our stakeholders, and how do we manage these climate risks on our balance sheet in order to continue adding value to the balance sheet rather than destroying it? And thirdly, also very, very important, and here is where I see the banking system and ING sees the opportunity, is how do we help transitioning and support transitioning of the economy and of our clients toward the greener world. What we have done in ING, I do believe a majority of you know, we have been a pioneer in this area almost for 20 years. We have really, through our integrity charter and through our strategy from almost 20 years ago, clearly set up that sustainability lies close and at our heart, and that everything we do, we want to do with green eyes, and we want to contribute to the successful transitioning of the world. We have been also pioneer one of the so-called scientific approach, so-called Terra, where we actually, for the 9 sectors that are most polluting to our portfolio, but as well to the economy as such, we have set up a precise measurement of the risks in our portfolio, and we are measuring and steering our portfolio yearly with respect to declining of the CO2 in our portfolio lending book, and compare it to the market itself, to the industry, and clearly to the available climate risk scenarios. And clearly we are not perfect, and we understand that there is a lot to be done, and we are clearly improving every year. And just recently we have issued, I hope some of you have read, our 22 climate risk report, in which we have clearly reconvened our message that we are strongly committed to the topic itself, that we want to be a banking leader when it comes to defining new ways of doing business in which people and planet will come also before the economic growth. And having said that, transparency around what we do and how we do probably is most important in order to make sure that we identify and measure our risks, and then clearly with our underwriting policy and with our pricing as well impact the direction that certain industries and certain clients will take. This year we have as well worked strongly on further strengthening the governance around management of climate risks within the bank, because we do want that every of our processes is considering as well this overarching climate risk in its decision making. So having said that, I just wanted to give you examples. For example, how do we do that on different segments? If we look, for example, at the corporate portfolio, we have created a number of sustainability KPIs linked products. This means that in pricing, the part of the interest margin for the bank depends on the success of the client in meeting its climate and environmental related KPIs. So the client is incentivized to reach its targets that have been set and have been also yearly checked during the credit annual review by the credit officers. And if he is on the track with the targets, it might benefit from decreased pricing. There is a number of examples, and I would invite you again to read our climate risk report, where there is a good example of, for example, Philips, and how we deal with this client, and how we actually promote clients' successful, I would say, focus on its own environmental KPIs, and actually helping them with the pricing that is being adjusted with every successful milestone. On the retail side, and here we are, as you know, as well, a very strong player on European market, actually specifically in a strong Western economies of Netherlands, Belgium, Germany, but also Poland, Romania, and others, Italy, Spain. We have developed a product which is called eco mortgages, where we are as well offering a significant discount depending on the energy label of the assets to be financed. And clearly there is some additional incentive, for example, for the personal loans for the consumers that want to further enhance, I would say, the climate friendliness of the asset to be financed. There is a number of other products that have been in the pipeline for production and for offering to the market in order to further incentivize businesses and consumers to do their best. The message that I would like to leave here at the desk is that definitely it is one of the most important, if not the most important challenge that we are currently facing. I do believe there is no time to wait, but I also want to be sure and reiterate that we are doing this structurally and that we are not thinking only long-term, but we are setting ourselves the short and mid-term targets because it's a journey. We need to go on that journey and look around ourselves, which are the changing consequences, which are the changing data, which is maybe requiring the modification of the strategy going there. And we are clearly committed to reach net zero up to 2050, but as well in our internal risk appetite, we have defined, for example, the first targets already for 25 and for 2030. We will check these targets, and clearly if we are on the right way, if there is a need clearly to modify those depending on the developments clearly around us, this is the only way how we're going to monitor and make sure that in 2050 we have reached our targets. However, it's a journey, as I said, and it goes step by step, and it's important that we have everyone on board. When I say everyone, I mean primarily governments, which I believe needs to be in a driving seat. Clearly, businesses that in the end have ultimately to change the business models and to actually achieve the transformation, but as well consumers, because their behavior is very much important and also impacting the success of the overall change. And I'm happy as well in the second part of this event to share some of our views as well on the need, how the policies need to be structured and maybe better to incentivize certain part of the industries, and how banks ourselves, through their, as I say, advisory and also financing important role, might help this transition to happen. Clearly, we need also understanding from the regulators that there are certain capital treatments that are more favorable than the others, because differently than traditional financial risks that we are facing, where we are actually assessing through scenarios and stress tests, I would say the risks mid to long term on our solvency, climate risks are something that is happening over the decades. And I do believe at this point of time, it is more important to understand and to enhance how the banks and financial industry assess the risks rather than the quantitative output, because it might be far away in the future as for the communities to take it seriously. So I do believe paying attention to developing the proper methodologies, collecting data, which is another issue that we are facing in daily life, because as we know, until in some geographies, the first disclosures of the large companies will only happen in 24 with the financial data 23, and we are already asked to be actually ready for this transitioning until the 24. These are all challenges that I believe in a constructive dialogue with the regulators, with the others in the financial industries, but as well with the businesses and consumer communities needs to be discussed in order to best practices to be put in place and best policies to incentivize and increase capabilities of some of the sectors. So that would be shortly from my side, just as an impulse for discussion that I'm looking forward to it and happy to answer any of your questions in the second part.
Thank you very much, Liliana. I'm sure that there will be many questions because you gave indeed a lot of impulse to us. But before we do that, let me also refrain from asking questions and give the floor to Irene for our last speaker, and then we open up the floor.
Yeah, good afternoon, everybody, also from my side. And really, leveraging on how you just concluded, Liliana, I would like to introduce Livio Stracca. Livio Stracca is Deputy Director General of Financial Stability at the European Central Bank. He has a long experience within the European Central Bank, being before Deputy Director General for International and European Relations, and before the Division of Policy. And he had also adjunct positions at Frankfurt University at Goethe. And however, Livio is also highly involved with the activities of the European Central Bank in climate financial risk assessment and climate stress test, and in particular with the activities of the Network for Green the Financial System, who has been developing climate scenarios for climate stress tests of the industry, and has just released its third vintage of scenarios. So, Livio, the floor is yours.
Thank you, Irene. I hope you can hear me well. So I will give a bit the perspective of central bank. So I have to say that I am myself a bit of a late convert to the idea that climate change is important for central banks. But as you know, those who convert late become even more fanatical. So than the others. So maybe this is going to happen with me as well. And I have to say, the more I look into it, the more I see that climate is important for the financial sector. So the more details I delve into. So I just wanted to start a bit with a general view of the banks. So I will be focused mostly on the banks. So banks are influenced by climate change in several ways. So in terms of the physical risk, you have both the more kind of acute events. I mean, the phenomena that were already described by Jerome, so the floods, droughts, and so on. But it's also the rising temperature also have a more chronic effect. So some areas become more deserts, agriculture suffers. So you have also this long-term damage that is a little difficult to model, but is there. So all these translate into credit risk for banks, but also corporate bond repricing. Some of the banks also hold a significant amount of corporate bonds. And in terms of transition risk, there is a number of elements. It's not only the effect of say increasing in carbon price or any other mitigation policies. It's also the adjustment of both banks and business to them. So things have to be looked at in a dynamic perspective where business adjusts and banks also endogenously adjust to what business does. So that's why, from a modeling perspective, it's highly difficult and challenging because you can expect that actors. I mean, we are all economists. We expect actors to behave endogenously to respond to risks. So that's why a purely static perspective is not so useful. So in terms of running now a climate stress test, which we have done at ECB and other central banks and supervisors do, so there are a number of elements to consider. So you can run a stress test from a top-down perspective. So basically, you impose on the bank. So this is the scenario. This is so you give us the data, but we do the stress test. We run a stress test, or it can be bottom-up. So the banks can themselves judge what the risk would be for them if under a scenario which is given by the supervisor or the central bank. But there are also other elements to be considered. So one is the horizon. So which horizon do you do the stress test? It should be a short one, a long one. What is the perimeter? So should it be only the banks or also non-bank intermediaries? I mean, insurance sector was mentioned, and is very important. So what should we consider also interactions between different parts of the financial sector? And another important modeling consideration is a bit related to what I was saying before, is should we consider a static or dynamic balance sheet? So should we take basically say the exposure to say the highly polluting sector that we observe today? Should we project into the future? Or should we expect that the banks will adjust endogenously the exposure in the future, responding to risk? So how this can be done from a modeling perspective? So all this is complex, that we are working on these aspects. So let me say a few words about the latest ECB supervisor stress test, which was released in July this year. So this was a big exercise which was conducted on 104 Euro banks. So the main message of this exercise is that the banks are still largely unprepared to address climate change risks. So, for example, around 60% of the banks don't have a climate risk stress testing framework. Most banks don't include climate risk in the credit risk models. And just 20% of the banks consider climate risk as a relevant variable when they grant loans. It was already measured by Liliana that 2/3 of banks' income to the non-financial corporate sector derive from so high emission sectors, so energy, for example, or manufacturing. So the overall message is that this is a journey, but the banks need to step up their effort to prepare themselves to understand climate risk in a much more comprehensive way. So these stress test, just to be clear, is not a traditional stress test where the result of which is a capital requirement or something that then feeds into the supervisory cycle. So was just a first information. It was a basically more qualitative purpose to find out, if the banks are well equipped to understand those risks, and if the data also that are necessary to have, an informed risk assessments are there or not. Because of course the data and disclosure is an extremely important and underdeveloped element or dimension in this. So I would say the supervisory stress test was useful, but it's certainly only the beginning of a work from both the banks and us as regulators and supervisors. I just wanted to finish also, as was mentioned by Liliana and also Jerome, so this positive element of the green investment is really important. And one element that we have emphasized at ECB is also the role of financial structure. So in the end of the day, we will need innovation in this field. So without innovation, we will not solve this problem. So I think the idea that the emissions will go down in an orderly way and the world will behave, I think is be naive. So what will actually happen is something much more nonlinear, where hopefully some radical innovation will bring about the desired path. But of course, there may be a much more pessimistic scenario. So innovation is going to be crucial. With current technology, will not solve the problem. And so the question is, what financial structure we need to do that? We know that equity as opposed to debt appears to be more desirable. So we know that non-bank intermediation seems to be more useful than banks. We know that banks tend to lend to high emission sectors, so more than non-banks. So we have also launched a little bit this idea of the green CMU. So the idea that so the Capital Markets Union in Europe would also have a green element, which is also a financial structure element. So let me end with this kind of notion, which is very important. Thank you.
Maybe let me ask my co-organizers, Elena and Irene, whether they want to add something towards the end. So because we are approaching the last 2 minutes.
No, I just want to thank the three speakers for their great intervention and presentation. I think this was very insightful and very useful for us. So thanks a lot for being with us today.
Yeah. So I can, Irene, you want to say?
No, same for me. It was absolutely insightful, both from the policy, regulatory, and also, tackling major issues like data and measurement of risk. So
thank you very much for today, and I wish everybody a good night. It's exactly 7 o'clock, so I'm proud that we met at least this deadline. Exactly.
Thank you very much.
So,
thank you.
Bye.
Thank you.
Thank you.
Bye bye.
Thank you very much. Bye.
Bye.